Thanks everyone for coming out today. Hasn't been many presentations face to face for the last few years, so it's good to see everyone. Today I'll be talking about the DPN regime with the tax office. It's probably a pretty hot topic with accountants at the moment. We're seeing a lot of them come out on a daily basis. So I'll just, earlier in the financial year, we saw the tax office issue 82,000 warning letters to companies stating that they were intending to issue DPNs to the directors for outstanding debts. Recently we've seen them issuing between 150 to 500 DPNs a day at the moment. The ATO's also advised the courts that in the next month, coming on October, they expect to be doing their full enforcement, both DPNs and companies. We still haven't seen a huge pickup in the court listings yet, but it is on the rise. It's the highest it's been in the last 3 years. In our discussions with lawyers and accountants around town, we've seen that the ATO has moved from allowing pretty much any payment arrangement put forward from companies to being very inflexible at the moment. They're wanting at least 20-30% up front, proof the company is solvent and can meet the payment arrangement. And they're not, I haven't seen anyone successfully get an arrangement over 24 months yet. So it is fairly difficult out there if you're running a business that hasn't had significant cash flow through COVID. You're finally starting to see profits, but you're not able to renegotiate that payment arrangement. So we saw the lockdown DPN come into force a number of years ago, and that was effectively the ATO trying to stop themselves being what a lot of people would say is probably the largest and easiest credit provider in the country. There was a long period of time where you just didn't, if you didn't lodge, you didn't have to pay, and there was really not much the tax office could do other than commence an audit or do an assessment. So they brought in the lockdown DPN, which effectively was forcing companies and directors to become compliant. They have increased that to bring in the GST and superannuation. We've seen in the last 12 months that superannuation penalty increase from 100% to 200%. They have, in the last 6 months, put out a paper on on what the company needs to have achieved to be able to get that remitted. But my experience, I had a company have to go through a liquidation purely because it was a few days late in its superannuation lodgements, and they just wouldn't budge on that penalty, which sort of raised a $300,000 debt against the company. So unfortunately, it was a bankruptcy and a liquidation for what was a profitable company. There was a change in the Fair Work regarding the casual employees and permanent staff classifications. I have had a few clients that have come into issues with their superannuation because the ATO has deemed employees into different classes, and effectively their accounting system didn't allow for that, and they were raised some hefty penalties, and again they just weren't able to negotiate down that penalty because they couldn't show that they had put into place the corporate governance they needed for that. So I guess with the DPNs, there's a critical date that surprisingly a lot of accountants that I go and see still don't realise these critical dates, which is 3 months after the due date. There is an extension if you're using a registered tax agent. If your lodgements are outside that period, then effectively you're personally liable. You may not get that DPN for a number of years, but it's there until it's been paid out. And I've seen instances where companies have gone through the liquidation, been deregistered. 3 years later, the directors received a DPN in the mail and had no idea that it was outstanding, because he thought it was all dealt with in the liquidation. Similarly, superannuation, shorter period. You have a month to lodge your guarantee. Unfortunately, there's not much you can do to get out of that personal liability. It's either place the company into administration or a winding up. The ATO does say you can appoint a small business restructuring practitioner, but effectively to be eligible for that scheme, the super has to be paid. So it's not really a solution for companies if there is a major superannuation debt there. So traditionally the old DPNs provided for that 21-day period, and that is you get your notice and you had 21 days to effectively negotiate a payment of the debt, appoint an administrator, appoint a small business restructuring specialist, or seek to wind up the company. We haven't seen a lot of the 21-day notices anymore. From my experience in the past few months, it appears that the ATO has been sort of on the robo-debt path where they are spitting out these director penalty notices. Traditionally, it used to go to a manager and they would review it and issue it. So we've seen a lot of errors in the DPNs, and so it does provide an opportunity for professionals to seek to set those aside. And I think the critical thing is to get that application in with the tax office quickly. They are saying at the moment that the wait time is up to 12 months for them to deal with the DPN challenge, which is pretty significant if you're a director and you've got a huge DPN hanging over your head. Recently, legislation was brought in for the credit score reporting. I have seen the ATO really pick up on the credit reporting. To note, that is done by their compliance division rather than the debt recovery team. So a lot of the time that step's been taken to force engagement with the tax office and get the taxpayer in front of the manager there to negotiate payments. Once it goes to debt recovery, that's when we're seeing the issuance of DPNs, Garnishees and winding ups. I think one of the major issue for incoming directors, which a lot of people won't be aware of, is your requirement within your once you're appointed a director, effectively you have 30 days to assess the company's tax liabilities and its compliance. And in that period, if you have identified that there is outstanding debts, you can't simply resign as the director. It won't save you from the personal liability. You are required to either enter into the payment arrangement or place the company into a restructure. You'll find that a lot of directors don't necessarily do that due diligence, and I have a case study on a company recently where the directors were able to negotiate and set aside a DPN because they did take the proactive steps within those 30 days to identify, report, and get a specialist in to negotiate with the tax office. So recently, we've seen a lot of DPNs issued in the past sort of 3 or 4 months, there hasn't been a huge amount of enforcement of those DPNs at all. We have seen the credit reporting occur a lot, especially for larger debts. Historically, the ATO pre-COVID was issuing a lot of garnishee notices. I haven't come across many garnishees lately. I know that the OSR has started to go down the garnishee path, especially with the recovery of the JobSaver payments. There is a lot of issues with those, especially with overpayments to clients, not necessarily the fault of the actual company, but the system that was rushed through has caused a lot of errors with payments. And the OSR's view at the moment is that that is payable. It should have been identified by the company and repaid. So they're being very difficult to negotiate with, especially with those JobSaver payments. So I thought I'd just run through a case study that we've come across, which was again directors coming into a new large company. They identified, effectively they came in, they replaced the old management. Shareholders weren't happy with that. They came in and identified errors in disclosure of the superannuation of over $3 million. Effectively could have resulted in $9 million worth of total debt there. They were issued with DPNs following the disclosure. Fines were not applied. Again, they had to take this to the ATT, and they had this set aside, the DPNs, again because within that 30-day period they had identified and engaged with a professional to be able to negotiate with the taxation department regarding the superannuation and get it onto a payment arrangement. That is one of the lucky cases. We recently had to do an administration with a deed for a company where they had negotiated a payment arrangement. A day before the first payment was due, they issued DPNs on the directors, and the directors effectively put the company through an administration with that same payment arrangement, with the view of avoiding the risk of the DPN sitting on the company, over their heads personally for the company. So we have seen the tax office very aggressively issuing these DPNs. They have got issues with them. A lot of the time they aren't being reviewed. There's names missing, there's incorrect taxpayers on there. I actually had a legal demand issued on me for a refund on my last tax return, which was very interesting. Demanding a refund a refund to be paid to me, otherwise they'd be taking legal action. So they have their system has shown some real errors with this robo sort of debt collection that they've done recently. So I would be encouraging those who are dealing face to face with their clients to get them to address these very quickly so that they can get in that queue to try and have these DPNs overturned, especially with the errors that we've identified. So our view in the insolvency world is, come October, we think there'll be a big uplift in ATO enforcement, especially around the liquidations. The DPNs seem to be favoured at the moment over simply garnishing the company. I think ideally for the ATO, it's a good way for them to grab and get security over real property of directors. There's been a lot of growth in real property, and it's a good PR. It's a good PR piece for them because they effectively are putting out that they're just going after derelict directors rather than forcing companies to wind up. But it is something that I think we're going to see a lot more voluntary administrations and the small business restructures, which have since they've been rolled out. They haven't been significantly taken up by the marketplace, but over the past sort of 6 months, we have seen a lot more appointments in that small business restructure space. So that's sort of my summary for today. Happy to take questions on anything. Yes?
What's a small business?
The small business restructure. So it's effective. A small business practitioner.
Yeah.
So that's effectively, I think there's only one that isn't one that's been approved that isn't a liquidator. So it's a system used like a voluntary administration for an entity that has compliance with the tax office. So there's a number of things you've got to achieve. No outstanding employee entitlements, creditor base less than $1 million, and you can go through with a small business restructure, which effectively means the company appoints a practitioner to review a proposal and put a recommendation out without taking charge of the company. So it lowers the costs of doing a turnaround, because naturally if we're appointed as administrator, have to run a company, we have that exposure of personal liabilities. So the costs, you're not looking at getting through an administration for under $40,000-$50,000 minimum with professional costs. The small business is a fixed fee up front, and it provides an opportunity to restructure for those smaller medium businesses.
Are they a certain type of practitioner?
Yeah, it's effectively a registered liquidator. I think there's only one. They've issued only one other licence outside the professional liquidators that are out there. Yes.
What's the process for challenging the DPN?
So there is a department in the taxation office, and it's a lodgement of a form with them to challenge the DPN. They are saying that the wait list on them to actually address that challenge is over 12 months.
So do they give you an undertaking
That they're not going to enforce, that they won't enforce on the DPN while the challenge is looked at, but that you're looking at 12 months.
And if you're not happy with it, their decision.
And then you've got to go to the AET. Yep, that's correct. But that's a big stress on a director to be waiting 12 months with a large debt hanging over their head for something that may have been issued incorrectly. We're sort of seeing, the ATO's guidelines. It's 21 days they're meant to respond to inquiries. That's gone out the window. They've effectively said that they are no longer model litigants. They're not going down the model litigant path anymore. Their view is that they will defend and recover by any means at the moment. So they've been very difficult to deal with in court as well.
How long has that been for that process?
Challenging the DPN. It's always been there. There's a number of defences that you can challenge on. Effectively, you need to show that the company took all necessary steps, and what they want to see is an improvement to your corporate governance around, like, why did it occur and what's that you've put in systems to avoid it occurring in the future. There is some provisions for not, having external advice or also sickness of the director in that period. It's very limited to.
I remember one case, Daniel, years ago, I don't know whether it still applies, where one of the directors who received DPN went round to all the other directors and said, we've got to do something about this, only got 21 days, we've got to put it into liquidation. And none of them wanted to put it into liquidation, none of them wanted to appoint an administrator. And his defence was that he took all reasonable steps to try and wind it up.
Yep. They said, no, you could have applied for a provisional liquidator by yourself. There was something else that you could have done.
Which would be, he didn't take that step to. You effectively have to go through each step, and if you can't get that done, show that you've gone to the next step, which would have been that last step. Making the application or taking the step to try and wind up the company. But again, it's very difficult if you're on a board with 5 or 6 other directors, it's unlikely you're necessarily going to get that done in 21 days.
Oh,
And are you going to go and spend your own money to try and wind up a company where your fellow board members are going to probably oppose your application if they don't believe it's, insolvent? So, there are a lot of horror stories out there, especially with them issuing DPNs and agreeing on payment arrangements. Why would you enter into a payment arrangement if you know you're going to get a DPN thrown over your head? You're probably better off to go through a restructure. Yes?
In that example you've just given, I think you've suggested that resigning is your directorship will assist.
No, doesn't assist, no.
Really,
Yes. Yes, exactly. So if you were to take an appointment, understand that once you've taken that appointment, even if you've identified the issues, if your other board members aren't going to assist, resigning isn't going to necessarily help you. You'll have to incur the cost of showing that you've taken those steps to restructure or wind up the company to be able to avoid that DPM being issued. Yes?
How have you found the ATO's attitude to, say, safe harbour provisions under the Corporations Act? Have they responded?
I haven't had a lot of experience. We've only done 1 or 2 safe harbour provisions. I haven't seen them attack the safe harbour provisions. I don't think there's many cases out there at the moment where the ATO's tried to pursue when there has been a proper safe harbour in place. I think a lot of the time those safe harbour provisions really are only for the larger listed entities. So I don't think we're getting to the point where the ATO's they're going for the low hanging fruit, the small, medium, mum and dad businesses with maybe $1 million worth of tax. That's easier to get that home secured against rather than the larger corporations where they know they're going to have a fight on their hands. Anything else, or I'm happy to pass on? Fantastic.
Thanks, Daniel. Elucidating presentation, Daniel, and the DPMs are getting more and more mischievous. So thanks again for the clarity of your communications. And welcome everyone. So we're going to talk about current problems with trusts and how to overcome them. Voila. So, trusts have been around for a long time. In fact, they started in the Crusades. Most people don't know that when people went over to fight in the Middle East, really to open up trade routes, but okay, to spread the gospel as well. If you didn't occupy the land that you were using, then it got forfeited to the Crown. So when people went over to the Middle East to fight with King Richard, etc., they'd get their father or their brother or their child to occupy the land that they were occupying until such time as they returned, if they ever did return. And so you had the 4 elements of a trust way back then. So you had a beneficiary, which is the soldier returning. You had the trustee, which is the father or the brother, holding the 3rd element, which is the property, on certain terms, which is the 4th element, which was when the brother or son, whoever comes back, they are then allowed to occupy the land again. So the 4 elements of a trust have been around for a long, long time. But we get problems from the drafting of a trust deed, from how the trust is used, and sometimes where the trustee is not aware of what they're doing. And one of the real problems, which happens all the time, is losing the trust deed. You've got to keep that trust deed. The bottom line is it's not just a little piece of paper that you can, have the dog walk all over or treat it like we used to treat old newspapers. They're really important. Why are they so important? Well, as we say here, if the trust deed is not stamped, for example, we need it signed, dated, stamped. If it's not stamped, it's like a blank piece of paper and cannot be used at court. Section 304 of the Duties Act. So you don't have a trust as far as a judge is concerned. You can't use it in evidence, you can't use a copy of it. It's zero. Not stamping it means you cannot ever change the trustee. Why is that? Well, because the Office of State Revenue will say, well, before I stamp the transfer going from Acme Proprietary Limited to John Smith & Co Proprietary Limited, I want to see the original signed, stamped and dated trust deed. So if you don't have that, you'll never be able to change your trustee. The third issue is that third-party financiers, banks are a bit jittery about trusts, don't like them particularly. None of the bank officers really understand them, and so they want to see the signed, dated and stamped trust deed before they'll lend money. And another reason is that, as we say at the bottom of this, the trustee has a duty to follow the terms of the trust. So how are you going to follow the terms of the trust if you don't have the trust deed to read what you can and can't do? If you just sort of go off the top of your head, potentially what you do is void, because if you don't have the power to do it, it's just void. It's a nothing, and the beneficiaries may well want to sue you for the losses they've incurred. So it's a real no-no to do that. So here's one situation. You find a copy of the stamped signed trust deed. You've got a copy of the stamped signed trust deed. This is probably the best situation. Sometimes a financier will want to see the original stamped and signed trust deed, but where they want to do that, you've got to go through the concept of getting a replica deed, which means the settlor and the trustee re-executing a whole new trust deed, and then say, well, this is the same as that, and there you go, Mr. Bank or financier. The problem is what happened this year on the 19th of May. Section 8AA of the Duties Act, that charges ad valorem duty on any acknowledgement of a pre-existing trust. There was a case last year in the Supreme Court of New South Wales where the judge said, look, this is just an acknowledgement of a trust that's already existed, so I'm not going to, can't put the legislation couldn't be have been worded or intended to have double duty if people are just saying, well, that's a trust, an acknowledgement in writing, but they've plugged up that hole, and so that's a real problem. Now, I'm going to go through a number of ways of dealing with lost trust deeds, and almost every one of them, this new Section 8AA just plugs it up. So lost trust deeds are now a really big problem for people in the business community. So where you've got 8AA applying, the duty is not $500, but it's calculated on the value of the dutiable property as at the date of the acknowledgement. So you could be paying double duty on a property that was bought last year. Unstamped signed trust deed is found. This is the easiest. So it's not stamped, but it's signed, it's dated, and somebody's just forgotten to go down to the OSR. So if it was created after 2009, the stamp duty on when you're setting up a trust is typically $500 if the assets are below $16,000. Most of the time the settled sum is $100. There's your $100, and that finds its way into an account hopefully very soon after the trust is established. Although there will be penalty interest if you want to get it stamped and you're outside the 3-month period. That's generally manageable by most people. Unstamped copy of signed trust deed has been found. Well, you just stamp it as a copy under $299, $50, and then you go back to what we did immediately before, pay the $500 plus interest, all sweet. Then we've got down here unstamped, unsigned copy. This seems to be the most common. The lawyer will say, oh, here's the last version. You know, it goes into his soft copies, as does the accountant, or even the clients will go and, oh, this is the last version of the trust deed before it got signed. This must be it. So it's unstamped, it's unsigned, and it's apparently a copy of the trust deed. So if the settlor and trustee, assuming they're still alive, now sign it, we've got this 8AA problem. Because duty under the section is calculated on the value of the dutiable property, as I said, at the time of the acknowledgement. So if this, say, is years old, and this is all you can come up with, a computer-generated copy of that, the lawyer or accountant that you haven't seen for 10 years, what does the trust have at the point where you're trying to get it stamped? And that dutiable property is what is going to be assessed, unfortunately. And this is the worst case where you can't find anything. There's only 3 options. You can continue with the limited powers given under the Trustee Act. So this Act is now almost 100 years old. You didn't have derivatives in 1925, okay? So it's a very unsophisticated piece of machinery. For some reason, it has hardly been amended in 100 years. I don't know why, but it's there. So you could sort of stumble along like driving a car built in 1925, I guess. Secondly, you can apply to the Supreme Court seeking orders that the new trust deed is restated and adopted. A lot of people do that. It's very expensive. Any court application is expensive. And that will work, although Mac's case indicates that you need clear and convincing proof. You just can't make it up as you go along. So you've got to prove that there was a trust. What were the terms of the trust as best you can recall, and maybe going back to primary documents and emails and records that were kept, it must have said this, or those must have been the beneficiaries, and patch up for the judge what you think the trustee used to deal with. And judges are reasonable, and the equity courts are reasonable, and if they can see that there clearly was a trust and the basic terms of the trust, the judge will typically make an order. The third option is to create a restatement deed by the beneficiaries. A lot of people don't realise that if the beneficiaries of a trust bandy together and they're all sui juris over the age of 18, they're absolutely entitled, so they're not default beneficiaries, but they have a genuine interest in the trust, and they are acting unanimously. They can change the terms of the trust, but of course now this section 8AA may well cause a duty, but ad valorem duty on the current assets of the trust to be applied. So losing a trust deed is a big deal. Where is the settled sum? So you've got the deed signed on the 1st of January 15. A bank account's opened on the 10th of January 15, and the $100 is deposited on the 20th of January 15. Sometimes it's $99.50, and you wonder, and the evidence is, I paid $100, so the settled sum there. And that amount that goes into the bank account must correspond exactly to the settled sum, because you've got the ATO who hates everyone, as we've heard from Daniel, so well put. And if they can knock out a trust, they go for the easiest thing first. They don't like trusts, and they'll go for this. Okay, show us with your bank accounts going back 7 years. Who can remember what they had for breakfast yesterday, let alone why the settled sum was put in 10 days, 20 days late? And what will the ATO say to you? They'll say just what I've said. Well, you've got the 4 elements of a trust: trustee, trust property, beneficiaries, in terms of the trust. But you only had 3 on the 1st of January. You didn't have any trust property. You had that 20 days later. So you never had a trust. You didn't have a trust on the 1st of January. And you still don't have a trust, because putting the money in 20 days later doesn't mean that the trust was constituted on the 20th of January. It means that no trust was constituted on the 1st of January. So how do you deal with that in a practical sense? Well, what you do is that you go to the bank.
Sorry, just a minute. I'll cash on hand.
Well, I'm just about to get to that. So you go to the bank, and the bank says, look, I can't open up a bank account today. Look, we're busy, and we need a copy of the signed, dated, stamped trust deed. And you say, well, I can't create it without money in the bank. And so you've got this catch-22 mess. So you get the $100, and you pin it to the trust deed as a practical matter, or it can be 10, but $100 these days is clearly indicates, there's enough money to clearly indicate that the settlor intended a trust. I mean, technically you can open up a trust for 1 cent or 5 cents, but it's an issue of whether really, did you really intend to? You don't want those sort of arguments. $100 is really good. Pin it to the trust, and then the trustee keeps a file note which he, sleeps on under his pillow at night, or her pillow, and the file note says, I received $100 from the settlor, Mr. Bloggs, and I've pinned it to the trust deed, and I'm making arrangements to open up a bank account, and I've got the money, so I'm going to get the trust deed stamped. That can take, several days sometimes. And then once you've got everything the bank needs, you say, there, Mr. Manager, I've got my signed, dated, stamped trust deed, and I've got my $100 cash. Please open up the account. And then 7 years later, when the ATO wants an audit, you can say, well, here's my file note. This $100 was pinned to the trust deed and it got deposited on the 20th of January. And here's the bank statement indicating that happened. And then the ATO will have to go on back to Plan B, whatever that might be. Okay, litigating the meaning of the terms of the trust deed. This is a very sad case. Carter's case. Beneficiaries were unaware that the default beneficiaries clause had been activated, and they sought to disclaim their entitlement after they became absolutely entitled. The court found that the term absolutely entitled is determined at a point of time just prior to midnight at the end of the year of income. So what happened was the trustee failed to make a positive declaration or resolution as to who was to get what, and this default clause sprang into action and said if there's no resolution as to who's to get what, then John, Mary and Fred get it. And it just means that it saves everyone a tax problem because the liability of John, Fred and Mary in terms of tax is likely to be less than the trust, which will pay tax at 47 plus 2% Medicare, which is great if people know what they're doing and they're aware. But in this situation, the beneficiaries didn't want the money for various financial reasons. They didn't want it that year, and they didn't even know that this default beneficiary clause had been triggered. And so they issued the disclaimers. When I say the disclaimers, it took them 3 goes before it was in fact the November set of disclaimers that ended up being litigated, November after the 30th of June. And the full federal court said, yeah, look, those disclaimers work and your entitlement, and they disclaim your entitlement to the money. So that gift has been disclaimed. But the tax office said, well, hold on a minute, and we're going to take the issue of whether the tax liability has been disclaimed. We'll take that to the High Court, which they did. And this is what the High Court said. At the moment before midnight, the default beneficiary clause applied and the default beneficiaries became absolutely entitled to that money as at this moment before midnight. And the disclaimer, therefore, in the third bullet point, did not apply from a tax point of view because the beneficiaries had become absolutely entitled to the distribution. So, the disclaimer did apply in the general law, as I've said. So there's no morality in tax law, and we need to make sure the trust deed is clear, that you understand it as a trustee or you understand it as a beneficiary. If the trustee had been alert to what his obligations, I don't know, he is her, their obligations were, and had communicated what was going on and had made the distribution earlier, all would have been well. So that's a sort of very unfair situation that can arise with trusts. Another situation is where you get poor drafting. And this Wheatlands holding case is a classic. Again, these are all current cases, 2022 in Western Australia. So in that case, the question was a simple question. Did the power of variation extend to allow a corporate beneficiary to be added to one of the discretionary income beneficiaries? We want to add a beneficiary. Can we do that? Anyway, I won't read out the variation clause to you, but it went on for about 300 words, and I think the lawyer was making it up as he went along, and it was really hard to understand. So they had to litigate it. And the judge eventually said, oh, look, this is really messy, but in the event, yeah, it actually does, and we got out of that case these concepts that the courts say the words of a clause in a trustee are to be given their ordinary and natural meaning. It says what it says. Yes, okay, that amendment clause works. But the fact is, if it had been very clear, you wouldn't have had to go to court to determine whether or not it captures that situation. Ruling from the grave, some people just, I don't know, have big egos, whatever, and they don't want to die and they want to rule. They have these memorandum of wishes, typically not enforceable. There are ways around it. If you want to control things after you die, you can have a hardwired nominated trustee appointment clause. When Fred dies, the trustee is to be Harry, and Harry's consent to act as trustee is attached to the irrevocable consent is attached to the trust deed, maybe, or the will. You can use a general appoint-all clause, which is far more popular, and I think they work really well. You can bequeath the corporate trustee shares specifically to those who will benefit from the trust, so those who benefit from the trust control the trustee. Not entirely. The appoint-all can trump, of course, the trustee. You can have the appoint-all being the people, or the person that you want to benefit from the trust, perhaps. Or, as I've said here, perhaps only have one person whom you trust, quote unquote, being the trustee. Here's another one. Can the trustee, the settlor, or the appoint-all be a beneficiary? I bet any of these good people here in front of me today who are familiar with a particular trustee, it might be your own family trust, I bet there's a clause in there saying either that the trustee can't be a beneficiary, or the settlor can't be a beneficiary, or the appoint-all can't be a beneficiary. And my question to you is why? Why can't a trustee be a beneficiary? The answer is there's no reason whatsoever. However, if you look at the duties of a trustee, did you know that a trustee can be unreasonable? A trustee can be unfair? There's no law saying a trustee cannot be unreasonable or a trustee cannot be unfair. There are laws saying a trustee has to keep accounts, has to supply information. A trustee has to act in good faith, as we know. It has to consider all the beneficiaries. It cannot act capriciously or whimsically. So the question is then, at what point does the unreasonableness or the unfairness start to breach these other obligations that are there? If you're being unreasonable, are you being capricious? Are you considering the beneficiaries properly? And it seems to me that the person that they're appointing, the trustee, they actually don't trust. And that's why they're saying you can't be a beneficiary, because they don't want the trustee's interests competing against other beneficiaries. Or the settlor can be a beneficiary, but often if you're a beneficiary, the beneficiary clause says all these people can be beneficiaries or are beneficiaries, and their spouses and their children. So you've got a settlor as a beneficiary, and then the settlor's child can be a beneficiary. And 102 of the 36 Tax Act says that if you're giving a distribution to the child of the settlor, then that child's distribution will be taxed in the hands of the trustee as if you're giving it to the settlor. So you actually don't get a benefit of the child being, say, under the $18,200 threshold. If a settlor is earning hundreds of thousands of dollars a year independently, the gift to the child is going to be taxed at the highest marginal rate. So that might be a reason not to give to not to have the settlor a beneficiary. And there's nothing, and I just can't think of a reason why you wouldn't want to have the appoint-all as a beneficiary. So there are other problems with trusts. This might seem very banal But hey, what is the name of the trust? Is it the William Discretionary Trust? If it's the William Discretionary Trust, call it the William Discretionary Trust. Don't call it the Billy Discretionary Trust. If it's got a company's got an ACN, use the ACN. If the trust's got an ABN, use the ABN. Talking about trading in derivatives, that's a good idea, but have you read the trust deed to determine whether the powers of the trustee extend to trading in derivatives? When is the vesting date? Oh, it expired last year. Try telling the ATO that. Plus the beneficiaries, they'll be really happy. And you're still trading and the vesting date's come and gone. You're facing at least one application to court to extend the vesting date, and that's very difficult. Execution, who signed where? I find people, when they're signing documents, tend to treat it as, not tend to, but can be flippant about it. They're telling each other stories. You know, a lawyer or the accountant's trying to sign something off and they're nudging each other about what happened at drinks on Friday night. I had a guarantee come across from a Bowes recently, and it was for $500,000. This optometrist had passed away. He was a great optometrist, a terrible businessman. He'd guaranteed everything, guaranteed the franchisee's obligations under all sorts of instruments, and he'd guaranteed an equipment lease for $500,000. Anyway, his widow came to me and said, oh, look, you know, I've got this guarantee from my David signed, and the Bank of Queensland want the estate to pay the Bank of Queensland $500,000. Thanks for coming. So we had a look at the guarantee, and sure enough, he was a really bad businessman, and they'd all signed on the wrong spot. I don't know what they were doing that day, but the franchisor was signed as the guarantor. The guarantor, who was the franchisee, signed as the franchisor. The long and short of it is, the guarantee wasn't worth the paper it was written on. So you can be lucky in a big city, as I said to them at that time. But the point about it is, execution is really important. Read the deed. Stand. Okay. So, trustees, changing trustees. Section 54 of the Duties Act says that none of the current trustees or the continuing trustees after the change can be beneficiaries. Otherwise, we're going to ping you for ad valorem duty when you change trustees. And, which is what a lot of people forget, that exclusion, if you even amend the trust deed to say none of the current or continuing trustees, I've read Section 54, I'm really clever, that none of them can be beneficiaries. If you don't say that that exclusion can't be changed, then it won't help. So, it's just a trap for young players, that one. A lot of people like to hide their identity. They don't want to know that they've just bought a property. So, and Section 55 of the Duties Act deals with this. So they use a bare trust to hide their identity. So it's Acme Proprietary Limited as bare trustee for John Smith. And there's only two things that Acme has to do. One is buy the property, and two, with John Smith's money, and two, transfer the property to John Smith when John Smith feels like it, which may be years away. So you've got to keep a paper trail of where the money came from, because you're a beneficiary under the bare trust. The Office of State Revenue will want to see exactly where the money's come from, and that's pretty easy to do. But where a lot of John Smiths run into problems is that they can't afford the whole property, so they have to borrow. And the mortgage covenants are sort of regurgitated by the bank, as we know, and often refer to the advance being made to the mortgagor. But where you're hiding yourself with a bare trust, the advance isn't being made to the mortgagor, it's being made to the beneficiary of the bare trust. So again, read the documents, because if that gets to the attention of the Office of State Revenue, they'll say, well, you didn't supply all the money. The borrowed money was supplied by the trustee. And you're going to be hit with double duty, because when you transfer the property from the trustee to the beneficiary, you'll be paying duty once again. Foreign entities, this is nasty, isn't it? I'm sure many of you would be aware of this situation. So we've got the beneficiaries of your family trust include the spouse of each child, your children, spouses of each child. In our situation, a middle son, Bob, he's 25. He's agreed to work in Los Angeles for 5 years. It's a great opportunity of a lifetime. Off he goes. He meets Sally, who is a US citizen, and they marry. The discretionary trust buys some residential independently of this. Bob's over there, but he's an Australian citizen. He hasn't given up his citizenship. But Sally is a US citizen. Independently of this, the discretionary trust buys some residential property in New South Wales, as trusts often do. The amendments to the Duties Act say that Sally is a foreign person. So therefore the trustee is a foreign trustee. Therefore the trust is a foreign trust, and therefore penalty purchaser duty at 8%. That's 8% more than you'd otherwise pay. It's not just 8%. It's 8% more than you'd otherwise pay. And penalty land tax, currently 2%, but on the 1st of July next year we get a wonderful little gift from the state coffers. It rises to 4%. And that applies even though Sally may never receive a distribution of any income or capital. So how do you deal with that? Again, you've got to have a clause that excludes foreign entities from being beneficiaries, and that clause can't be amended. So there's a lot that can go wrong with trusts. Capital gains, we're all familiar with the Bamford amendments, streaming of capital gains and streaming of franked dividends. Does the trust deed allow for that? Read the deed before we all run off and start streaming capital gains. Ensure that there's power in the trust deed for that to happen. And then we get to CGT event K3. So ordinarily, as we know, there are no CGT consequences when an asset passes to an executor or to a beneficiary on the death of the testator, and any capital gain or loss is postponed until such time as the executor or the beneficiary then sells the property, assuming it's a post-CGT asset. So you inherit the cost base of the deceased. But CGT event K3 is different, doesn't work that way. It talks about an estate trust, it talks about passes, it talks about non-tap property, it talks about to foreign beneficiaries. So there are 4 things that it talks about. Foreign beneficiary is pretty obvious, and it's a discussion on its own, so we won't spend much time on that. But explaining CGT event K3, the executor is the trustee of the estate assets. So we're talking about trusts, and it gets to not only business succession, but also includes personal succession and trustees of personal estates. And the executor, until such time as the debts have been paid in full, the executor holds the assets for the beneficiaries. That's how the law sort of deals with that, because the person's dead. What do we say now? Let's say the executor's the trustee. This is all just sort of made up in the Succession Act just to make things work. So the foreign beneficiary becomes absolutely entitled to the non-land property, like 10,000 CBA shares. This is when the property passes. It says the property passes. Legislation talks about passing. It doesn't talk about transferring, i.e. sign a transfer, register it at the Land Titles Office. It talks about the property passing, and the legislation, section 104 and Tax Determination 2004/3, say it passes when the foreign beneficiary becomes absolutely entitled. They become absolutely entitled the moment that last bill is paid. Once all the debts are paid, the property passes to the foreign beneficiary. So the question for all of us is the foreign beneficiary a foreign beneficiary at the time that last estate debt was paid? That's the question. Not when the will was signed, not when probate was obtained, but at that moment in time that debt is paid. If the foreign beneficiary was a foreign beneficiary at the time that last bill was paid, CGT is payable by the estate. That is, by the beneficiaries who aren't getting the property. How good is that? Not much. So CGT event K3, how can this be managed? So I set out here a number of ways that you can manage this. You can gift the tap or the land to the foreign beneficiary. There's no tax on that, payable by the beneficiaries. The foreign beneficiary will only pay CGT if the property is sold by the foreign beneficiary. That makes sense. You could have a power of appropriation in the will. It's also in the Trustee Act, where you can say, well, I don't want the $10,000 car, I want the $10,000 worth of shares. So this is appropriation. Or I want $10,000 in cash, and the beneficiaries, if they all agree, they can alter the terms of the will. Have the foreign beneficiary compensate the estate in the will. You're getting these 10,000 CBA shares, but you won't be paying any tax on them because I know you want to buy a house over there. So I'm going to have a clause saying that you've got to compensate the estate for the CGT on those shares, or an equalisation clause in the will. So the non-foreign beneficiaries, the Australian beneficiaries, somehow get an equalising payment. That's one way it can be done. And other ways that it can be done are things like transferring the non-tap property to your Australian resident testamentary trust and have the foreign resident a beneficiary, and there's not going to be any CGT event there. That way, distributions of income to a non-resident beneficiary will be taxed, but the capital gains on the non-tap asset will not be taxed until it's disposed of. We'll hold the non-tap asset in an Australian individuos trust and pass control of the trust to those you wish to benefit. Now, the last slide is not more stamp duty. You know, up till about 2016, they were getting rid of stamp duty. I think stamp duty on mortgages was abolished around 2014, 2015. Stamp duty on the sale of business went in 2016. And now, all of a sudden, you're getting all these new taxes. It might be something to do with our $1 trillion foreign debt, I don't know. But as you may know, there's an annual property tax commencing on the 16th of January for New South Wales properties up to 1.5 million, optional at the moment. And the Victorians are really getting slugged with rezoning tax. Rezoning tax applies from the 1st of July 2023. All you have to do is do nothing and you get rezoned, and if there's a capital improved value exceeding $100,000, 62.5% of it goes into the state coffers, less allowable deductions, which probably isn't much. So no free lunches for the Victorians, unfortunately. And voila. That's it. Any questions? Everyone gets quite miserable when I talk about these things. But,
Me? Sorry, the question. Just going back to that $100 example.
yeah.
Is it legally allowable not to ever bank that $100?
You don't have to bank it.
Indefinitely, until vesting.
Yeah, well, you don't have to bank it, but what are you going to do with it?
Well, just say that just like medication tea, you just come up with the trust requirement of the asset.
Well,
But is there a trust or not?
well, there's a trust. Of course there's a trust. But if this money is going to go into a piggy bank somewhere, it'll end up getting lost or spent on the trustee's children's next birthday present. See, this is the thing. This is why lawyers like, we're the gatekeeper where things, client comes to me and asks that question, I say, look, just put it in a bank account, okay? You want the trust to work, put it in a bank account, the ATO will be happy, the Office of State Revenue will be happy, your wife will be happy because you won't destroy the trust, and everyone will be happy. So there's a good reason why we recommend these things, because it works. A trustee, you will never have to ask yourself whatever happened to that $100, and that's actually what happens, because people get the $100, then they sort of, whatever. I'll reimburse the trust, the account later, and the amount that gets put into the bank account 20 days later is $10.50, or it's $103.70, which correlates exactly with some income that was earned. In other words, there's no settlement money at all. That's the problem, where you can't remember what you did with it. So,
Just good practice.
good practice, yeah. Yeah. Helps you sleep at night. Good idea. So, any other questions? No other questions, so going. Thank you everyone for coming. I hope you've enjoyed it. There should be a paper in the plastic bag. If you don't have the paper, thank you.